What if I told you that some of the wealthiest people in the world use an investment strategy that's so simple a complete beginner could understand it in less than 10 minutes? But here's the surprising part. It's not secret stock picks. It's not cryptocurrency. And it's definitely not some complicated trading strategy. Most people think successful investing means constantly watching the market and trying to predict which stock will explode next. The reality? That approach causes many investors to underperform the market. And that's where index funds come in. They're one of the simplest, most powerful tools ever created for building long-term wealth. Yet millions of people still don't understand how they work. So in this video, we're going to break down index funds in plain English. No confusing jargon. No complicated formulas. Just everything you need to know as a complete beginner. And make sure you stick around until the end because we'll cover one mistake that can cost investors thousands of dollars over time. Let's dive in. Main point 1. What is an index fund? Imagine walking into a grocery store. Instead of buying one apple, you buy an entire fruit basket. Inside that basket are apples, oranges, bananas, grapes, and dozens of other fruits. If one fruit goes bad, you still have plenty of others. An index fund works in a very similar way. Instead of buying shares of just one company, you're buying tiny pieces of many companies all at once. Think about some of the biggest businesses in the world. Technology companies, healthcare companies, banks, consumer brands, energy companies. An index fund can hold hundreds or even thousands of these businesses in a single investment. Now you might be wondering, who decides which companies go into the fund? Good question. This is where something called an index comes into play. An index is simply a collection of companies grouped together. For example, one of the most famous indexes in the world is the S&P 500. It tracks roughly 500 of the largest publicly traded companies in the United States. When you buy an S&P 500 index fund, you're essentially buying a small piece of all those companies. Instead of trying to find the next big winner, you own a little bit of all the winners. And that's an incredibly powerful idea. But here's what most beginners don't realize. Owning more companies doesn't just make investing easier. It can actually reduce your risk. Let's talk about why. Main point 2, why investors love index funds. Benefit number 1, diversification. Imagine investing all your money into a single company. Everything looks great. The future seems bright. Then suddenly, the company faces problems. Sales decline. Management makes mistakes. Or a competitor takes over the market. Your investment could suffer dramatically. Now compare that to owning hundreds of companies through an index fund. One company struggles. The impact is relatively small. The rest of the companies continue working for you. This concept is called diversification. And it's one of the most important principles in investing. Benefit number 2, low fees. Most people underestimate how much fees matter. Imagine two investors. Both earn similar returns. But one pays significantly higher fees every year. Over 10 years, the difference might seem small. Over 20 years, it becomes noticeable. Over 30 or 40 years, the difference can be massive. Index funds are often known for having lower fees because they simply track an index instead of constantly buying and selling stocks. Less management. Lower costs. More of your money stays invested. And that's exactly what long-term investors want. Benefit number 3, simplicity. Let's be honest. Most people don't want investing to become a second job. They have careers, families, businesses, school, responsibilities. Index funds remove much of the complexity. Instead of spending hours researching individual companies, you can focus on something far more important: consistency. Because building wealth isn't usually about making one perfect investment. It's about making good decisions consistently over many years. Now here's the question every beginner asks. How do you actually start investing in index funds? And can you begin even if you don't have a lot of money? Let's find out. Main point 3, how to start investing in index funds. Step 1. Define your goal. Are you investing for retirement? Financial independence? A future home? Your children's education? Knowing your destination helps you choose the right path. Step 2. Choose an investment platform. Depending on your country, this could be a brokerage account, investment app, retirement account, or bank investment service. Step 3. Choose an index fund. Remember, not all index funds track the same markets. Some focus on one country. Some focus on international markets. Some cover thousands of companies globally. Step 4. Invest consistently. This is where many successful investors separate themselves from everyone else. They don't wait for the perfect moment. They invest regularly. Month after month. Year after year. And step 5. Stay invested. Markets will go down. That's normal. Every major market in history has experienced declines. But many have also recovered over time. The investors who often benefit most are those who remain focused on the long term. Conclusion. Index funds aren't flashy. They're not exciting dinner table conversation. And they won't make you rich overnight. But they have helped millions of ordinary people participate in the growth of businesses around the world. They're simple. They're diversified. They're accessible. And for many beginners, they're one of the easiest ways to start investing. If you found this video helpful, hit the subscribe button and join us for more simple personal finance and investing content. And leave a comment below. If you had an extra $100 today, would you invest it or spend it? Thanks for watching, and we'll see you in the next video.